In the modern financial arena, there are operators who achieve success through quiet, patient analysis, and there are those who achieve it through loud, public, and often brutal confrontation. Bill Ackman belongs firmly to the second category. He is the quintessential modern activist investor, a figure who has transformed the act of investing from a passive analysis of securities into an active, high-stakes campaign to force corporate change. He does not simply buy stocks. He buys companies, or at least a large enough piece of them to give him a powerful voice and a seat at the table. His strategy is not to predict the future, but to actively intervene and create the future he believes is most profitable. This is not the story of a trader who reads the subtle flickers of the ticker tape. It is the story of a financial crusader who uses meticulously researched public presentations, the global media, and the mechanics of corporate governance as his primary weapons. His career has been a series of dramatic, high-profile battles, marked by both spectacular victories and equally spectacular defeats. To understand how Bill Ackman moves markets and wins with big bets, one must first deconstruct his intellectual playbook, the unique fusion of deep value analysis that identifies an opportunity and the activist's methodology that unlocks it. In this first part, we will explore the architecture of an Ackman campaign, his core philosophy, his process for identifying a target, and the art of crafting the powerful public narrative that is the opening salvo in all his greatest battles. To understand the operator, one must first understand his journey. Bill Ackman's path was forged not in the chaos of a trading pit, but in the hallowed halls of Harvard. After earning his MBA from Harvard Business School, he co-founded his first investment firm, Gotham Partners, in 1992. It was here that he began to develop his activist approach, achieving a series of early successes. However, his first venture ended in failure. Gotham collapsed in the early 2000s, primarily due to its investments in illiquid assets and a public battle over a golf course company. This early failure was a critical, formative experience. It taught him painful but invaluable lessons about the dangers of illiquidity and the complexities of public confrontations. Armed with these lessons, he launched his second and far more famous venture, Pershing Square Capital Management, in 2004. He had a new, more refined mandate. He would focus on a small number of high-conviction activist investments in highly liquid public companies. The core philosophy that drives Pershing Square is activist value investing. This is a powerful hybrid doctrine that separates Ackman from both traditional value investors and corporate raiders. Like a classic value investor in the mold of Benjamin Graham or Warren Buffett, Ackman's process begins with a relentless search for undervalued companies. He is not interested in speculative, high-flying growth stocks with no earnings. He is a student of intrinsic value, looking for businesses that are trading for significantly less than they are worth. He specifically seeks out companies that are simple, predictable, and generate a large amount of free cash flow. He is a devotee of the wide moat concept, looking for dominant businesses with strong competitive advantages that protect them from competition. This is the value part of his DNA. But this is where the similarity ends. A passive value investor, having found such a company, would simply buy the stock and wait patiently for the market to recognize its error. Ackman believes this is insufficient. He argues that often the market is correct to assign a low valuation to a great business that is being poorly managed or is pursuing a flawed strategy. The value is latent, trapped inside the corporation. The second and most important part of his philosophy is the activist catalyst. He is not a passive investor, he is an agent of change. His alpha, his source of outsized returns, comes from his ability to identify a great business with a correctable flaw, and then to use his position as a major shareholder to force the company to fix that flaw. The changes he typically pushes for are fundamental and structural. They can include replacing an underperforming CEO, spinning off or selling an unprofitable division to streamline the business, changing the company's capital allocation strategy, for example, by stopping a wasteful acquisition and instead buying back its own undervalued stock, or even pushing for the outright sale of the entire company to a better owner. This activist approach completely changes the investment equation. Ackman is not just betting on a stock, he is betting on his own ability to influence its future. This is the foundation of his big bet mentality. Because each campaign requires an immense amount of time, research, and often a multi-year public battle, he cannot diversify in the traditional sense. His strategy necessitates a highly concentrated portfolio, where he places massive, high-conviction bets on a handful of ideas that he understands with extraordinary depth. The hunt for one of these targets is a rigorous and highly disciplined process. The first screen is for quality. Ackman and his team at Pershing Square are looking for businesses that are, in his words, simple, predictable, free cash flow generative, and dominant. He avoids industries that are subject to rapid technological change, or that are heavily dependent on commodity prices or government regulation. He wants businesses that he can reasonably understand and forecast for years into the future. The second screen is for undervaluation. He seeks a massive discount to a conservative estimate of a company's intrinsic value. This provides the classic margin of safety that protects his capital on the downside. But the final and most critical screen is the search for the correctable flaw. There must be a clear and identifiable problem that is depressing the company's value, and it must be a problem that he believes can be solved through his influence as a major shareholder. This is what separates an Ackman target from a simple value trap. A cheap company in a dying industry with no competitive advantages has no correctable flaw. It is simply a bad business. A dominant, world-class company with a great brand that is being mismanaged by an entrenched CEO, however, is a perfect Ackman target. This entire process is a form of private equity-style analysis applied to the public markets. It involves months of deep, painstaking due diligence, including building a comprehensive financial model, studying the company's competitors, and often talking to industry experts and former employees to build a complete, multidimensional picture of the opportunity. Once the research is complete and the conviction is high, the campaign begins. Ackman's primary weapon, the tool he uses to launch his activist campaigns and to move markets, is the public presentation. This is his modern form of market influence. He does not operate in the shadows. He operates in the full glare of the public spotlight. His presentations are legendary. They are not simple marketing documents. They are often multi-hundred-page university-level dissertations filled with exhaustive research, deep financial analysis, and a powerful, compelling narrative. The structure of a classic Ackman pitch is a masterclass in persuasion. It typically begins by praising the target company. He will start by outlining everything he likes about the business: its great brand, its dominant market position, its valuable assets. This is a strategic move that establishes his credibility. It shows that he is not a simple short seller trying to destroy a company, but a concerned owner who appreciates the company's potential. Having established the company's inherent quality, he then pivots to the problem. He will deliver a detailed, often scathing critique of the flaw that is holding the company back. This is usually aimed squarely at the current management team or the board of directors, outlining their strategic errors, their poor capital allocation decisions, or their failure to adapt to a changing environment. After deconstructing the problem, he presents his solution. This is a clear, step-by-step plan for fixing the company and unlocking its trapped value. He will outline the exact changes he is demanding. Finally, he presents the valuation. He will provide a detailed financial model showing what the company is worth today, and what it could be worth if his proposed changes are implemented. This provides a clear, quantifiable upside for other shareholders, giving them a powerful incentive to support his campaign. This entire process, the deep research followed by a powerful public presentation, is the architecture of his big bets. It is how he builds his case and begins the process of moving the market to his point of view. This deep analysis of a company's fundamentals is what identifies the potential for a major re-rating. But to understand the underlying market structure of such a company before an activist like Ackman even considers it, to see the subtle signs of accumulation or distribution that precede a major move, requires a different but complementary set of tools. The master of this was Richard Wyckoff, who created a complete methodology for analyzing these hidden campaigns by smart money. To deconstruct his principles and learn how to read the market's true intentions, we have created a dedicated channel, Richard Wyckoff Trading Methods. We invite you to subscribe via the link in the description to deepen your understanding of market mechanics. The analytical playbook is now complete. We've seen how Bill Ackman identifies an undervalued, underperforming business and constructs a powerful public argument for change. But a presentation is just the opening salvo. The real battle begins when the activist goes public, waging a high-stakes campaign to move the market and bend a corporation to his will. That is the art of the public campaign, and it is the subject of our continuation. Having built the intellectual case for a big bet, the activist's work has only just begun. A meticulously researched presentation is a powerful tool for laying out an argument, but it is merely the opening salvo in what is often a long, brutal, and very public war for the control and future of a corporation. The true genius and the true controversy of the Ackman method lies not just in his analysis but in his execution. He takes his private research and transforms it into a public crusade, using the media, the mechanics of corporate governance, and the court of institutional opinion as his primary battlefields. In this section, we will deconstruct how Bill Ackman wages these campaigns to move markets. We will then analyze two of his most famous and consequential battles: a triumphant multi-billion-dollar hedge that stands as one of the greatest trades in modern history, and a dramatic multi-year war against a corporate giant that serves as a powerful cautionary tale about the immense risks of his high-stakes approach. The public campaign is the art of transforming an investment thesis into an unstoppable narrative. Ackman understands that in the modern market, perception can, for a time, become reality. His goal is to seize control of a company's narrative, to replace the management story with his own, more compelling one. To do this, he employs a sophisticated arsenal of tactics. The first and most visible is the media blitz. Ackman is a master of using financial news channels like CNBC as a platform to broadcast his thesis to millions of investors. His interviews are rarely calm or measured. They are performances delivered with passion, conviction, and a mountain of data. He presents himself not as a speculator, but as a crusader for the common shareholder, fighting against an entrenched and incompetent management team. This allows him to frame the debate on his own terms and to apply immense public pressure on the company's board of directors. The second tool is the public presentation. Beyond the initial release of his research, Ackman will often hold multi-hour live-streamed presentations at investment conferences, where he will walk the audience, slide by slide, through his entire exhaustive thesis. These events are designed to dominate the news cycle, to arm other investors with his arguments, and to demonstrate a level of research and conviction that is almost impossible for the company's management to ignore. The third, and more formal weapon, is the letter to the board. These are often scathing, meticulously argued letters sent to a company's board of directors and simultaneously released to the public. They will call out management for their failures, question their salaries, and formally demand the strategic changes that Ackman is seeking. This brings the battle from the media into the boardroom itself. The final and most powerful weapon in his arsenal is the proxy fight. If a board of directors refuses to cooperate, Ackman can appeal directly to the other shareholders. He can wage a campaign to have them vote out the current directors and install his own slate of nominees who will then implement his proposed changes. This is the ultimate tool of activist influence, a direct democratic assault on the existing corporate power structure. The combination of these tactics creates a flywheel of pressure. Negative media attention spooks the board, shareholder pressure forces their hand, and the stock price often reacts to the anticipated changes, creating a self-fulfilling prophecy that validates Ackman's initial thesis. This entire playbook, The deep research, the big bet, and the public campaign is designed for a specific type of situation. But in early 2020, Ackman demonstrated his intellectual flexibility by applying the core principles of his philosophy to a completely different kind of trade, a trade that would become one of the most legendary in modern financial history, the COVID-19 hedge. The story of this trade begins with his core principle of deep, contrarian research. In late February and early March of 2020, while the broader market was still largely complacent about the threat of the emerging coronavirus, Ackman and his team were conducting an intense, all-consuming analysis. They spoke with medical experts, they studied the virus's transmission rates, and they concluded that the official pronouncements from governments and health organizations were dramatically underestimating the inevitable economic and social impact. He came to believe that the only way to stop the virus's exponential spread would be a complete, temporary shutdown of the entire global economy, an event that the financial markets were not even remotely pricing in. This was a classic Ackman setup, a profound and dangerous disconnect between the market's perception and a rapidly approaching catastrophic reality. He famously articulated this view in a highly emotional and now famous interview on CNBC on March 18, 2020, where he warned the world that hell is coming and pleaded for a national shutdown to save lives. But weeks before this public pronouncement, he had already placed his bet. He was not, however, selling his core portfolio of high-quality stocks. His thesis was that companies like Starbucks, Hilton, and Chipotle, while they would suffer in a shutdown, were durable businesses that would ultimately survive and thrive. To sell them in a panic would be a mistake. He needed a way to protect his portfolio from the short-term market collapse he saw coming. He needed a hedge. The instrument he chose was a masterstroke of asymmetric risk-taking. He invested $27 million, a tiny fraction of his fund's capital, into buying credit default swaps, CDS, on various investment-grade and high-yield corporate bond indexes. In simple terms, a CDS is a form of insurance. The buyer of a CDS pays a small, regular premium, and in return, the seller agrees to pay them the full value of a bond if that bond defaults. Ackman was not betting that these specific companies would go bankrupt. He was betting that the fear of bankruptcy would skyrocket. The price of a CDS contract is determined by the market's perception of credit risk. When the market is calm and confident, the price of this insurance is extremely cheap. When the market panics, the price of this insurance explodes. In February 2020, the market was calm. Ackman was able to buy a massive amount of this financial insurance for a very low price. This was the perfect big bet with a clearly defined and massively skewed payoff profile, the very structure that Paul Tudor Jones would admire. Ackman's maximum possible loss was the $27 million he had paid in premiums. This was his 1R, his unit of risk. His potential reward, if his thesis of a full-blown market panic came true, was astronomical. It was a 50-to-1 or even 100-to-1 opportunity. As the market's realization of the pandemic's severity caught up to his own in March 2020, credit spreads blew out, and the value of his insurance contracts exploded. In just over a month, he sold these contracts for a staggering $2.6 billion. It was a near-perfect hedge, a trade that not only protected his fund from the crash, but generated a monumental profit. But the true genius of the operation was in its second act. He did not simply sit on this massive cash profit. He immediately redeployed the entire $2.6 billion, plus more, back into the market at the moment of maximum pessimism. He used the proceeds from his defensive bet to go on offense, adding aggressively to his positions in the very same high-quality companies he had sought to protect, buying them at the deeply discounted prices of the March 2020 crash. This two-part maneuver, a brilliant asymmetric hedge followed by an aggressive reinvestment at the bottom, was a complete masterclass in capital allocation and risk management. While the COVID hedge was a story of spectacular triumph, Ackman's career is also defined by his equally spectacular and highly public battles. His multi-year crusade against the multi-level marketing company Herbalife stands as the ultimate cautionary tale about the risks of his high-stakes, conviction-based style. In 2012, Ackman announced that Pershing Square had taken a massive $1 billion short position in Herbalife. He did so with a dramatic 342-slide presentation titled, "Who Wants to Be a Millionaire?", in which he declared the company to be a pyramid scheme and predicted that its stock would eventually go to zero. This was the beginning of one of the most dramatic and personal wars in modern Wall Street history. Ackman's thesis was that Herbalife's business model was fraudulent. He argued that the vast majority of its distributors made little to no money, and that the company's profits came not from the sale of its nutritional products to real customers, but from the continuous recruitment of new distributors who were forced to buy large amounts of inventory. He launched a relentless public campaign to prove his case, lobbying regulators like the Federal Trade Commission to investigate the company and giving numerous, passionate media interviews. However, his public declaration of war attracted a powerful enemy. The legendary investor Carl Icahn, a man who had his own long and acrimonious history with Ackman, took the other side of the trade. Icahn publicly declared that Ackman was wrong, that Herbalife was a legitimate business, and he began to buy a massive long position in the company's stock. Their feud culminated in a now infamous live on-air shouting match on CNBC in 2013, a raw display of the immense egos and personal animosity involved. Icahn's buying, along with that of other major investors, created a powerful technical short squeeze against Ackman's position. The stock price, instead of collapsing as he had predicted, began to grind higher, inflicting massive paper losses on Pershing Square. The battle raged for over 5 years. While the FTC did eventually force Herbalife to change some of its business practices, it never officially labeled it a pyramid scheme or shut it down. The company's fundamentals remained strong, and its stock price continued to defy Ackman's bearish thesis. In 2018, having suffered hundreds of millions of dollars in losses and a significant blow to his reputation, Ackman finally capitulated and closed out his entire short position. The Herbalife crusade was a perfect illustration of the immense risks of his strategy. His deep conviction, which had served him so well in other trades, had in this case blinded him to the resilience of his opponent. His highly public stance had trapped him in a battle from which he could not easily retreat, and his powerful narrative had been countered by an even more powerful opponent. It was a stark reminder that in the world of big bets, the line between conviction and hubris is razor thin. Bill Ackman's highly public, confrontational style is a core part of his strategy. It is what allows him to exert pressure and force change. But as the Herbalife saga showed, it can also backfire spectacularly. Do you believe this form of public activism is a legitimate and effective way to create long-term shareholder value? Or is it a form of market manipulation that primarily benefits the activist's own high-stakes gambles? Share your thoughts in the comments. In conclusion, the legacy of Bill Ackman is that of the quintessential modern activist. He is a complex and often polarizing figure, a man who operates with a level of public conviction that is almost unheard of in the typically secretive world of hedge funds. His career is a study in the duality of high-stakes, concentrated investing. His successes, like the COVID hedge, are masterpieces of analysis, timing, and courage that will be studied for decades. His failures, like the Herbalife short, are equally powerful cautionary tales about the dangers of hubris and the immense risks of waging a public war against a determined opponent. He is a true value investor in his analytical approach, but he is a master strategist and a showman in his execution. His career proves that in the modern market, a powerful narrative, when backed by deep research and immense capital, can be a force capable of moving not just stock prices, but the very companies themselves. Before we conclude, we want to extend our gratitude to you, our viewers. We put an immense amount of research and effort into creating these deep dives, and your engagement is what makes it all possible. To everyone who watches, who subscribes, and who takes the time to leave a thoughtful comment, thank you. Your participation is what helps these videos reach a wider audience on YouTube. A special thanks is due to those of you who have supported the channel through the Super Thanks feature. Your direct support is a powerful motivator for us to continue this work and to keep raising the bar on the quality of our analysis. As a final recommendation for any serious market student, it is valuable to study the raw psychology of speculation, as it is the foundation upon which all market movements are built. The foundational text in this area remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. The main character, Larry Livingston, is the prototype of Jesse Livermore. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below.